As we look back, it goes without saying that the year 2020 was an extraordinary year by any measure, but it was clearly dominated by a pandemic that 12 months ago no one saw coming, and 12 months later remains with us today and has totally reshaped the global order in social, economic, and financial terms. Consider that on February 15th, the S&P 500, the broadest measure of US stocks, had just hit an all-time high. 5 weeks later, March 23rd, that same index was down by over 35%. So using the classic definition of a bear market, a market that falls by 20% or greater, the S&P 500 had entered bear market territory. 21 weeks following that, not only had it fully recovered those losses, but went on to establish any number of new highs over the course of the year, and in fact finished the year December 31st, 2020 at a new historic high. In preparing for this video, I went back and took a look at what were considered to be the investment risks for the coming year 2020. And there were many of them. Brexit, the impending impeachment of a sitting president of the United States, trade wars with China, and obviously the US election itself. But nowhere in those lists was there any thought or discussion around a global health scare, or certainly not a pandemic. So an exogenous event, an event that by definition cannot be forecasted. And for those who may have reacted to that event by removing themselves from equity exposure over the course of the year, the cost of opportunity in that move has been absolutely massive and is possibly not recoverable. In order to provide stability and confidence, global central bankers stood in, providing massive amounts of liquidity and driving interest rates to historic lows. With 10-year yields in developed markets trading well below 1%, savers were being punished, and it became apparent that the only option in order to preserve, create, and grow capital over a reasonable period of time was to invest in the stock market. And thus began the resumption of the old bull market or the beginning of a new one, depending on who you talk to. Looking at some representative global equity index returns expressed in Canadian dollars, the S&P 500 once again led the way with a return just over 14%, the MSCI World at 12%, and Canada was once again a distinct laggard at 2%. It's important to note that foreign equity returns were negatively impacted marginally as the Canadian dollar appreciated against the US dollar primarily over the course of the year. To better understand why the Canadian market has been a relative chronic underperformer, we have to look at the composition of the Canadian index. The TSX is not a well-diversified index and has largely been dominated by three sectors: financials, materials, and energy. Of the three heavyweights, only materials provided a positive rate of return in 2020, up 19%, largely on the back of gold stocks, as the commodity went up over 30% for the year. Financials, a 30% weight in that index, actually provided negative rate of return, as did energy, down over 30%. So both of those provided a stifling effect on that overall index return. The best performing sector was information technology, or infotech, up over 80%. And in fact, infotech has been the best performing sector in Canada for 9 of the last 10 years. Turning now to look at the same information, but on the S&P 500. It's very much a similar story at the sector level. Financials and energy generated negative rates of return, but as smaller index weights, they were easily offset by the performance of information technology once again, up over 40%, and consumer discretionary stocks up over 30%. Turning to fixed income returns, as central bankers acted quickly to provide much needed liquidity and backstops, interest rates collapsed, sending bond prices higher. And this is reflected in the fixed income returns, as seen here across varying maturities and credits in Canada. This slide shows a high correlation between corporate profit growth and the index, as ultimately the value of any business is determined by its ability to generate an economic profit now and into the future, and that value is then reflected in the market price of the business. I know this has been an exhausting and confusing time for all of us. No one forecasted a global pandemic, and certainly no one forecasted that in a year that would see the global economy shut down, that markets in many cases would go on to achieve new highs, certainly in the case of the US, but at least provide positive rates of return. If there's one takeaway from any of this, I think it's reinforcing the importance of having a globally diversified financial plan based on one's individual ability to accept risk and then having the focus and the discipline to allow it to work. Thank you very much for your time. Happy New Year, and please stay safe.